Another way to measure a company's ability to pay its current liabilities is with the acid test ratio. So the formula for this is you take the cash, add it to short-term investments and net current receivables. So these are things that you can quickly convert to cash, and then divide that by the current debt, which is current liabilities. So the acid test ratio tells if a company could pay all of its current liabilities immediately with its most liquid assets. So even though the current ratio is more popular than the acid test ratio, the current ratio is not really all that realistic. Because remember, the current ratio, on the number on top, is current assets. So that included inventory, and it also included things like prepaid assets, like prepaid insurance. Is it realistic that you're going to cancel your prepaid insurance, get the money back, and use that to pay off other bills? And can you really sell inventory quicker than you normally could in order to generate cash to pay off your bills? Well, you can't unless you discount your inventory significantly. So this acid test ratio is a more realistic way to tell if a company is going to be able to pay its current liabilities. So this leaves out inventory and prepaid assets because they are the least liquid of the current assets. And because they are left out in the top part of the equation, the result will be lower than the current ratio. And even though this is called the acid test ratio, most people call it the quick ratio. How can you quickly pay your current debt? And so it's going to result in a ratio, something like 1.2 to 1. So this is a ratio, not a dollar amount. And so the 1.2 to 1, or a result of just 1.2, because remember, a result of 1.2 is the same as 1.2 over 1. So what that means is for every dollar of the item on the bottom, a dollar of current liabilities, you have $1.20 to pay off those current liabilities. But also notice this acid test ratio includes net current receivables, which are net current receivables are AR and notes receivable due within 1 year. So even using those to quickly pay off your current liabilities is not super realistic. You can sell your current receivables and notes receivable. So this next ratio is an even more realistic way to measure a company's ability to pay its current liabilities. It's called the cash ratio. So the formula for the cash ratio is you take your cash and add it to cash equivalents like savings accounts, treasury bills that can be quickly converted into cash, and then use those to pay your current liabilities. So you're not having to sell your AR, and you're not having to sell your inventory or your prepaid assets such as insurance. So as you can see here in this example, the resulting ratio, 0.2, which means 0.2 over 1, is much lower than the other ones because this is a more stringent way to measure if a company is going to be able to pay its current liabilities. So a ratio of 0.2 would mean the company has 20 cents of the thing on top, cash and cash equivalents, to pay $1 of current liabilities. Well, is that good or bad? Well, you have to compare that to the industry average because industries are always different from each other. And in this case, it is pretty significantly low. It is very significantly lower than the industry average of 0.4. So now we're going to look at the ability to sell inventory and collect receivables. So we'll look at inventory turnover, days in inventory, AR turnover, and days sales and receivables. So we'll find out what these mean on the preceding slides or the subsequent slides. So first we have inventory turnover. The formula for inventory turnover is you take cost of goods sold and you divide it by your average inventory. Now remember, to calculate average inventory, you take your beginning inventory, beginning meaning the beginning of the accounting period, probably the beginning of the year, add it to your ending inventory at the end of the year, and then divide by 2. That gives you your average inventory. So it's comparing what you sold, the cost of what you sold versus the cost of your average inventory. So it's measuring the number of times a company sells inventory during a year. So do you want a high number or a low number? You would prefer to have the goods that you sold, to be the number on top, to be very high compared to your average inventory. So higher is better. And the reason cost of goods sold is used on top is because inventory, the number on bottom, is at your cost. So the number on top also has to be at our cost. It can't be sales, because sales is not at our cost. Sales is how much we're charging our customers. So if you get a result of 20, that means the company sells its average inventory 20 times per year. Now we're going to look at days in inventory. The formula for this is you take 365 days and you divide it by the inventory turnover ratio that you calculated from the previous slide. So this measures the average number of days the company holds its inventory before selling it. For example, on the previous slide, we said a result of 20 for inventory turnover means the company turned over or sold its average inventory 20 times in the year. So let's calculate the days in inventory. So 365 divided by 20 would result in 18.25. So a result of 18.25 means the company holds its inventory for an average of 18.25 days before it's able to sell it. So is that good or bad? Well, it depends on the product. If it's sushi and it's sitting on the shelf for 18.25 days, that's not good. So in this ratio, the lower the number, the better, because we want our inventory ideally to just touch the shelf and then someone to buy it and then it goes off the shelf. So we don't want our inventory on our shelves for very long at all. So if the number is higher than the industry average, the company's inventory on hand is probably too high. So if the company could lower the cost of inventory, lower the amount of inventory, they also are eliminating storage costs and insurance costs. So having a whole bunch of inventory on hand is kind of expensive. So the most successful companies are the ones that can minimize their inventory while still making enough sales to meet customer demand. And so this formula, days in inventory, is also known as days sales in inventory. Now let's look at some ratios to help determine if a company is selling its inventory and collecting its receivables. So we're going to look at AR turnover. This measures the ability to collect cash from credit customers. It's the number of times it collects the average AR in a year. So the formula, you take your net credit sales. So remember, this is dealing with AR. So we can't have cash sales on top. It has to be just the credit sales. And you're going to divide that by your average net AR. And remember, average net AR is going to be your beginning AR plus your ending AR divided by 2. So the higher the turnover, the quicker the company is collecting its AR. So you want a high number. But if it's extremely high, it might be because the company's credit is just too tight. So they're just not letting enough people buy on credit. And if credit is too tight, that means you're missing out on sales. Now we're going to look at a way to measure profitability. It's gross profit percentage. So the formula for this is you take gross profit, and now remember gross profit, you need to know the formula for that. It's net sales minus cost of goods sold. So you could just replace the top of this with net sales minus cost of goods sold, since that's what gross profit is. And then you're going to divide that by your net sales. So it's showing the percentage of each sales dollar earned as gross profit. So it's measuring profitability, but it's only considering your cost of goods sold. It's not considering all of your other expenses, such as tax expense, salary expense, depreciation expense, etc. So if you get a result of 0.25, that would be 25%, because remember this is a gross profit percentage. So a result of 0.25 means that for every dollar of sales, there's 25% of it, or 25 cents, of gross profit. And another one we're going to look at is called days, sales, and receivables. This measures the ability to collect receivables. So for this formula, you're going to take 365 days, and you're going to divide that by your AR turnover ratio. This will indicate the number of days it takes to collect the average balance of receivables. So do you want a high number or a low number? Well, obviously you want to be able to collect your receivables quickly, so you want a low number, because that means your cash is available more quickly. Sometimes people also call this the collection period. So that's a lot of formulas to throw at you all at once. So make sure you have these all written down, but we'll get a lot of practice with this in the homework.